You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, welcome back, guys. Welcome back, Hamish. What's cracking, my friend?
Not a lot. I had breakfast this morning. It's a little bit of a throwback to last episode. I've done it. I've managed it. And hey, we're actually doing the podcast earlier this morning. So what's up with that? That doesn't even make any sense.
That's right. Well, I forget. I thought you just like that was completely random, but I forget we were talking about that last week, weren't we?
Yes.
Eating breakfast in the morning.
Yeah.
I thought I was literally like, what's going on, Hamish? And he's like, oh, I ate some breakfast.
Woke up, made my bed.
Wow. Did a little research for the podcast, checked some stocks, yawned a couple of times, had a coffee.
Yeah.
Very good. Well, congratulations on eating breakfast. What did you have?
Thank you. Big achievement. I had a salami and cheese and tomato wrap that was toasted.
Really?
Yeah. So I didn't.
Wait, did you make that yourself?
I did.
Wow.
Yeah. So I've gone from no breakfast until midday to making myself a 5-course meal for breakfast.
Yeah. That sounds very fancy. Wait, what'd you say? Cheese, salami, what else?
And tomato.
Tomato. Oh, jeez. That beats my bowl of cereal.
What did you have? A bit of Wheat Bix?
Nah, I hate Wheat Bix. God damn. Well, Wheat Bix by themselves, I don't know. My dad's like, he just eats Wheat Bix without putting anything on it. I'm like, Dad, that's like the sign that you're a serial killer. You know that. But no, I can't handle that. I got to put stuff on my Wheat Bix. But no, I have like some Uncle Toby's antioxidant or something or other.
Ah, okay. Yeah.
It tastes pretty good. I like it. But anyway, on to what we should be talking about. You got a follow up on that crazy story from last week. Man, I still can't get over that. That's so crazy.
Yeah, that
else?
story was insane. If you haven't seen that last week's episode, then go check out that episode because for about half an hour I spoke about this crazy story that happened. So check that out. But I've got a bit of a follow up from that. We've got GameStop. A little bit of news out of them. The Reserve Bank of Australia, we've got a bit of news. Facebook is in a bit of trouble again. Surprise, surprise. Yeah. And
Australia's now able to travel back to New Zealand, Australians, which is pretty exciting. Well, from April 19. We'll get to that. And we got a couple more things from Amazon, AWS news, and a little bit more if we get time to follow up on Biden's infrastructure plan. So should be overall quite a busy podcast, I think. So let's get stuck into it.
Yeah. Today's episode is sponsored by Sharesight. So Sharesight is an application you can use to track the performance of your stock portfolio. And it's really good for keeping track of all of the different types of gains you experience as an investor. So capital gains, dividends. If you have a dividend reinvestment plan on any of your index funds or shares, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then the main reason why I've personally been using it over the past 3 or 4 years is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. You can use that link to sign up to a free plan and use it for as long as you want. And also, if you want to sign up to a paid plan for more features, use that link, sharesight.com/young investors to get 4 months free, or 4 months off, I should say, on a yearly subscription. So go check it out if you're interested.
Very cool. All right, where should we start? You want to start with this follow-up on what's the Archegos capital or whatever it's called?
Archegos. I don't know. I think I wasn't pronouncing it right. I listened to some people pronounce it after that, and I was definitely wrong. But regardless, we've got a little bit of an update, and I won't spend too much time going through the whole story because we spent a lot of time doing it last week. So I won't bore you with that.
But just quickly, they used a lot of leverage, had a massive margin call, right?
Correct. Yeah, they used a bunch of leverage. They used it to use these total return swaps, these derivatives to invest in a handful of businesses. and they didn't go very well. And then the investment banks that lent them the money basically through these swaps required them to put up $20 billion, and they had less than $10 billion. So they couldn't do it.
Uh-oh.
Yeah. So last week we kind of spoke about how those swaps work and the whole falling out of it, as well as a little bit of a background on the guy who was running the fund. But we didn't, of course, talk about the losses that the investment banks that lent this money out, the losses that they were taking because the dust was kind of still settling. And we have a little bit more clarity on that. So that's what I want to talk about today. Just before we get into that, I did actually make a mistake last week. I said that one of the companies that dropped 34%, I think it was Tencent. It actually wasn't Tencent, the $800 billion Chinese company. It's a much smaller Tencent company. So I thought I'd better correct that. It's Tencent Music Entertainment. It's actually a $40 billion company, and it is owned by Tencent, the bigger company. It's just it's a joint venture. It's a smaller business, and it's actually between Tencent and Spotify. So that's a correction from last week.
How dare you make a mistake, Hamish?
I know.
How dare you?
God. Yeah. Doesn't happen very often, but no, I'm just kidding.
It's the first mistake I've ever made.
God. I am now resigning from the podcast.
Yeah.
I'm stepping down.
Pack your bags. Anyway.
No, but so in terms of these investment banks, there's kind of three banks that I want to talk about. The first is Credit Suisse, which we spoke about last week, was at the tail end, at the back end of this, kind of the one that was caught holding the bag and was selling their shares last, was unable to get those shares off their books. And they took a massive loss. They now think the loss will be about $4.7 billion, which is gigantic. All the executives are losing their bonuses this year, and the dividend was also cut for the stock. So
wait, legitimately?
Yeah, legitimately. Yeah.
Oh, wow. I thought you were just saying that as a joke. You know how it's like at the end of The Big Short, that movie? They're like, and you know that after this happened, Wall Street got completely cleaned up and a lot of investment bankers went to prison. Just kidding. I thought you were going to pull that one on us, but no, you're actually being serious.
No, they actually did. I mean, no one's gone to jail or anything, but
no,
at least yet. It probably won't ever. But they've decided to cut their bonuses because they've taken such a massive loss. The second investment bank was Goldman Sachs, and they basically just said they're not expecting any material losses, so nothing that's substantial. But they're also not reporting that they had any profits. I was watching a CNBC interview last week, and someone on there said that Goldman Sachs may have made a profit on it, but that seems to not be the case. So Goldman Sachs is break even. They kind of got out. So that's kind of good. The funniest one out of this that I thought was very interesting was what happened with Morgan Stanley. Morgan Stanley is now reported as the bank that sold their shares first. So last week, I thought that we kind of speculated that it was Goldman Sachs because they were expecting to maybe make a profit on this trade. It's now Morgan Stanley that actually was able to sell a bunch of their stock the day before all of the other investment banks. And they basically were able to dump $5 billion the day before the Credit Suisse had to sell their shares and Goldman Sachs and all of these other businesses. And they did it in a bit of a dodgy way. Not sure if anything will come out of this, but basically how they got rid of the stock is they sold it to clients at a discount. So this wasn't a public trade. This was a private trade to some of their own clients that make them money. And they basically told them, hey, we're giving you this stock at a discount. And the reason why we're giving it to you as a discount is to prevent another client from defaulting. But what they didn't tell them was that there would be more selling of tens of billions of dollars in the next 24 hours. So
no, they're going to get sued, aren't they?
Yeah. So as far as at least there was a client that remained anonymous in this article, but as far as they know, they were not aware that there would be more selling. They only knew that, well, as far as they knew, that $5 billion that Morgan Stanley was selling was the only exposure to those stocks. So they were able to ship it off to those clients, which I'm pretty sure they're not clients of Morgan Stanley anymore.
No, but, it's not a great look for Morgan Stanley, is it? It's kind of like
No.
just screwing over your clients to protect, for the greater good, to protect your own business. You're going to screw over your clients. It's not a good look, is it?
Yeah, it certainly doesn't look good. But I guess if they are expecting to take billions of dollars of losses, and will we lose a few clients? I mean, I guess it depends how many clients they end up losing over the long term from this. Like, is it just these clients, or are there other people that are now dissuaded from going to Morgan Stanley because they did this? But yeah, we'll kind of see what happens. There's obviously going to be a long investigation that happens to see if anything illegal was done or if anyone's going to get sued or anything like that. But those things take time. So we just have to wait and see.
Geez, imagine being one of those clients though. Like, they'd be big clients of Morgan Stanley's and getting these discounted shares, and then you buying them, and then the next day, or in the weeks after, whatever, you realize that Morgan Stanley knew the day after you bought them that they were just going to drop like crazy. I mean, you're right. Technically speaking, it can't be Morgan Stanley's fault if they say, hey, would you like to buy this at this discounted price? But it's still dodgy AF that they say, oh, we're just going to leave out the fact that this stock is going to go down a lot tomorrow.
Yeah.
I don't know. I feel like a few of those clients are going, it's inevitable, right? They're going to try and sue Morgan Stanley over it somehow.
Yeah, well, I mean, if they've lost billions of dollars, you would imagine, like, what have you got to lose?
Yeah, exactly right.
If you've lost all of that money. But yeah, I would imagine that a lot of them thought they were getting a discount to what the price would be the next day, and that was just not true. They ended up paying far higher than how far the stock dropped, considering that Credit Suisse lost $5 billion and Morgan Stanley is in the clear. So
no such thing as a free lunch, hey? No such thing. Well, that's a very interesting follow-up, and classic Young Investors podcast style. We'll just have to wait and see what happens. But yeah, man. Yeah, I wouldn't be surprised if we see Morgan Stanley clients suing Morgan Stanley over running them up the creek.
Oh dear.
Is that all we got to talk about for the follow-up?
Yeah, that's all of it. Where do you want to go from? Where do you want to go from here?
We can talk about GameStop.
Yeah.
GameStop. As if there wasn't enough news recently about GameStop. Well, guess what? You got a little bit more. This one's actually pretty funny. Do you want to take us through this one as well?
Yeah. I mean, you might have more to say on this because you just had a video come out on it, but I just kind of wrote down some of the headlines here and some of the key numbers to note. But GameStop's management team and the company overall, I guess, as well, has finally decided to cash in on the frenzy.
Hey.
They've finally decided, because if you remember back, AMC, that the cinema business, was another one that another business or another stock that kind of became a meme stock and exploded. And the management team of that company quickly cashed in by selling more shares at the inflated price. GameStop didn't at the time, but now they have decided to do so. So they plan to sell. And if I get any of these facts wrong, correct me, Brandon, because you've done a video on this.
No, it looks all good. Yeah.
They plan to sell 3.5 million shares, which would dilute the shares by about 5%. And it's actually an at the market sale. So these shares are not going to be sold at a discount to the current market price, which is typically what happens, but rather they'll be sold at market, so at the current market price. And as typical, when a company says that they're going to be diluting the shares, adding more pieces to the pie, even though the pie isn't getting bigger, the stock falls a little bit. So the stock actually ended up falling about 7% over the past couple of days since the news came out. So fairly in proportion to the amount that the shares will be diluted if this entire sale goes through. But interestingly, through the article that I was reading, the company could raise up to, assuming that they sold the shares at the current market price, which is about $180 per share, and they were able to sell all 3.5 million shares, then the company could raise as much as over $600 million. And that would actually allow them to pay off their debts entirely. They currently have about $430 million in debt. It's pretty good. And that, of course, would be very, very beneficial to the short-term survival of the company, which I believe is not profitable right now. So
yeah, I'd need to go back and check. Yeah, I'm not sure.
Yes. Yeah. So certainly I looked at their numbers over the past 10 years, and the past 10 years revenue has just basically declined in every single year. And it's down almost 50%. I think it was like 9.8 billion to like 5 billion or something since 2012. So revenue has declined, and they were profitable. They're no longer profitable in the last couple of years. So this will certainly help.
This is such a crazy story. And I mean, we've been kind of joking about this happening, for quite a while. Like, GameStop should definitely use this time to their advantage. They've got, who's that new CEO dude that wants to come in and revitalize the business and turn it into a big e-commerce player or something like. I can't remember his name.
Yeah, I don't know his name, but he was the founder of Chewy, which was that e-commerce pet company. I think he came in as the chief marketing officer. Ryan Cohen. That's his name. So yeah, he wants to turn this sucker around, and The funny thing about this story, this is where it's kind of funny, is because short sellers of GameStop, those nasty, we hate them short sellers, they're actually going to be, if GameStop is successful in the long term, the short sellers are going to be a big reason for that success. And the reason why I say that, it's just so funny when things like this happen in the stock market. The stock market's never dull. It is never dull. Because of what Hamish was saying just then, the revenue declining over the last 10 years, no signs of stopping, short sellers who profit when the stock price goes down, they were really betting against this stock. Like, there was 140% of the outstanding shares were held in the short position. So the short sellers were really ganging up on this stock. And they left themselves open because it was so heavily shorted. They left themselves open for the short squeeze, which happened. And of course, the short squeeze drives the stock price up like crazy. It went from like $20 to at its top, it was $347. So you think about that and that was in like what, a few weeks, like a month or so. So short sellers gang up. The short squeeze is triggered. The stock price goes up like crazy. Yet now it has come down. I think it's at like $170, $180 per share. So it's not $347 anymore. But when you compare it to where it was like 3 months ago, it was sitting at $20 a share. $180 versus $20, it's still up drastically. It's still up like hundreds and hundreds and hundreds of percent. So the funny thing is that now it gives GameStop this opportunity where they can try and sneakily raise some money without diluting their shareholders too much, or they can raise a lot of money for the same dilution. So they can effectively raise all this money and put it to use and try and fix their business with this money. And really, it's all thanks to those short sellers. They made the whole thing possible. Yeah, it's kind of an interesting case study because it does give you an insight into how the share market can impact businesses. Because, of course, when we invest in a business, when I buy a stock on the stock market, I'm not buying the stock, usually at least, from the company. I'm usually buying it from just someone else who holds it. So in a way, the stock market for a large part is just a marketplace of people trading the stock separate from the business. But this is kind of a good case study of how that marketplace impacts the actual business and their ability to get access to money. Because depending on what the share price is, that impacts their ability to get debt. It also impacts their ability to sell shares and what price they can sell shares at. I just did a little bit of maths while you were talking then. So assuming they can sell those 3.5 million shares at the current stock price, as I mentioned, they'd be able to raise about $600 million. If you go back 12 months, just 12 months, and they sold those same 3.5 million shares at the current share price, they would have raised 10 million.
10 million.
So that is the difference in between a stock being shorted 140%, whereby their access to capital, excluding debt, their access to equity capital is 10 million, yes.
Yeah, 10,
Get confused with these big numbers. 10 million. And then fast forward, you have this Wall Street Bets thing happen, the short squeeze, and now their access to equity capital is 600 million. It's insane. It's a crazy it's a crazy case study that doesn't happen very often, but it's kind of an extreme example of how the share price matters to a stock if they need access to capital. So
absolutely. And it's quite fun, and that's and this is an example of I talk about this in the video I made. Raising capital. There's a saying that companies should raise capital while they can, not when they must.
Yes.
So it's kind of smart. Like, even though I think they said yes, the idea for this capital raise was to accelerate our e-commerce transition, but it's also for general corporate and balance sheet strengthening purposes. Like, normally if you see a capital raise and they say general corporate purposes, you're like, oh God, because it just means they're plugging some hole. They're essentially using their shareholders to plug some hole in the business. And you can bet your bottom dollar that, in 3 to 6 months time, they'll come back and do another capital raise for general corporate purposes. This is just like, this is an example of, the management team raising capital when they can, not when they must. Like, as you were just saying, if they had raised capital, if they had to raise this capital back when you were talking about, they wouldn't have been able, they would have copped the same dilution, but only raised like $10 million. I mean, are you serious?
Yeah.
Whereas now they can raise capital because they've waited until, they're raising capital while they can get so much more bang for their buck, less dilution for their shareholders, raise $620 million. And you could imagine $620 million, that is a lot of money. This could seriously go a long way towards funding a really big transition from a physical video game retailer to an online based retailer. It really gives them, the freedom to really push hard to try and to shift their business online. Like, granted, it's not going to be like an Amazon overnight kind of thing. But it's certainly much better for their business than having having $10 million to try and help them out. So, and it all comes back to the short sellers. That's the beauty of it all.
Thanks, guys.
Yeah, you'd feel absolutely stung as a short seller, though. Absolutely stung, because it's you that have shorted the stock so much that the short squeeze happened that enabled them to raise this money. And now you're like, they're in the best position they've been in for ages. They've got $620 million extra that they can put towards revitalizing their business. As a short seller, you're like, oh no. So I find that really funny.
Yeah, I hope that at least for the company, I like seeing companies succeed. I hope that the share price just stays right around where it is. I hope it doesn't collapse before they raise these shares. That would be kind of sad to see if the stock collapses to like $50 per share, and they're like, no, we were so close.
True. They still need to get it done. I wonder how long typically it is before announcing a capital raise before it actually happens. I guess it must vary, but I've actually got no idea what that time difference actually is.
Yeah, I don't know if there's like a typical time, but the last time that Corporate Travel, one of my shares that I follow, raised capital, it was about a month. So,
okay.
I don't know if that's normal. I don't know if it varies, but yeah, maybe within the next month or so.
And I don't know what it's like if they're doing this at the market. I don't know what sort of how they would do it in terms of their daily volume as well, not to disrupt the share price so much. But I can imagine if they're selling, diluting the shares by 5%, that might influence the stock price if they don't get it right. I'm sure there are experts in companies that make sure capital raises don't disturb the stock price too much.
Yeah,
I don't know.
You would imagine it would probably have somewhat of a similar effect to if a company bought back 5% of the shares. Like, it would send this, if you buy back 5% of the shares, it's going to send a lot of volume into the market. It would send the stock price up a decent amount. So you would expect, I don't know to what degree or whether you can even calculate that, but on the opposite, there would certainly be some significant downward pressure while they're selling those shares. That's completely normal to see, but yeah, we'll see to what extent that is and what price they're able to sell those shares at. It's not very common that they do these at market sales. I wonder if if anyone knows why you would choose to do that versus just doing like basically like an off-market private sale at a discount like they normally do. I don't know if there's. Do
you reckon maybe it's because if they're doing it just through the market, are they trying to almost get retail investors to buy these shares? Do you think, or whereas normally if you're doing a capital raise, you'd find like sophisticated investors with a lot of money. Maybe they realize that a lot of the people buying their stock are retail investors at the moment, so they need to just open up the shares to everyone. Is that a possibility? I don't know.
I mean, could be. I mean, if they did do just a discounted set price, they could still sell to both retail and institutional investors.
Okay.
That's what Corporate Travel did. They did kind of half.
Right.
I don't know if there's any specific advantage. Maybe they can spread it out over a longer period of time, kind of like a share buyback, where they say we're going to buy back $1 billion worth of stock, and then that's kind of just in a bank basically, and they just chip away at it over time. Whether that's what they're going to do, I don't know. If anyone knows anything more about this, feel free to let us know in the comment section of the YouTube version.
Mm. All right, should we move on?
Yeah, where should we go?
You want to hear something positive?
Yes, give us something.
Australians. Sorry, what were you saying?
I was just going to say, give us something happy.
All right, I will give you something very happy. Australians will be able to travel to New Zealand from April 19th. Wow. How exciting is that?
Wow, that's soon. It's very soon.
That is pretty soon, isn't it? It's very soon. It says here that the New Zealand government will allow Australian travellers to enter the country without mandatory quarantine. The article does highlight a few potential obstacles to getting over to New Zealand. They are anticipating quite high demand
wow, really?
for these tickets. There's also, they're very clear in saying that rule changes may happen, just like that, by the snap of the fingers, depending on what happens in terms of COVID for both countries. And they're also flagging, watch out, because of the high demand, you might be paying a decent price to be able to get over there. So it says here, the Trans-Tasman route is usually serviced by 4 main airlines: Qantas and Jetstar, Virgin Australia and Air New Zealand. But interestingly, not every airline is keen to go back there straight away. Virgin Australia will not restart most of its flights across the ditch until October 31st. Instead, it will offer a limited schedule for flights to and from Queenstown from September 18.
When I read that, not keen to go back there, is that just because Virgin just doesn't have the money?
Yeah, probably. Yeah. Well, I think I read somewhere in this article, I think that like a spokesperson said they need to be very, very careful of what flights they commit to. Yeah. And I think they just said with the still uncertainties and flights potentially being cancelled on a whim, that they're not quite prepared to risk that just yet. Yeah, that's why they're waiting. What else does it say? Meanwhile, Qantas and Jetstar will operate up to 122 return flights a week to all pre-coronavirus routes. Qantas Group says that that amounts to 52,000 seats a week and an 83% return to its pre-pandemic capacity.
Wow.
And New Zealand plans to run about 30 flights from Auckland to Australia per day. And a quick search of the cheapest return flights from Sydney to Auckland in the first week of quarantine-free travel. Jetstar return flight will cost you $479, Air New Zealand $608, and Qantas $658. There you go. We could potentially go back to New Zealand. Let's go hang out with Tom.
Yeah.
Let's go fishing with Tom.
I've never been to New Zealand before. It looks beautiful.
Haven't
though.
you?
No, I haven't.
Man, I don't know what you're doing in the next couple of months, but we should just bloody well go over there and just have a party.
That's excellent plan. Let's do it.
Actually, though, I would actually be keen. We can talk about this later, but I would actually be keen for that.
Don't put me on the spot, Brandon. All right?
Yeah, sorry.
No, that actually would be really good. That would be
fun.
That would be really good. That'd be fun.
Tom, we're coming.
Get ready.
Here we come. Get your skis on, mate. Let's go. Might have to wait a few more months for skiing.
Yeah. That's very interesting. Yeah, so 83% pre-pandemic capacity. I presume.
I know, I was surprised.
I presume they mean capacity for just that route, or are they talking about the entire group?
No, no. I think that's just the routes that they're taking to New Zealand.
Yeah, so that's pretty crazy. That's pretty impressive that they're able to get to that level. Yeah, it's very, very interesting. For me personally, a big hesitation for flying really anywhere at the moment is just how rapid the rules can change.
Yeah,
and
exactly.
getting not wanting to get stuck, particularly in like a foreign country. I know New Zealand's not really a foreign country, but you getting stuck somewhere where the rules change quickly and you just can't get a departure out of that place, whether it's domestic or international. So that kind of makes me nervous, but yeah.
It is a risk. It is definitely a risk. And they, like this article, I kind of chop those bits out because they say it every second sentence. You know, travelers are taking on big risks. Lockdowns could occur at any time. Yeah, but I find it interesting. I'm glad that it was we're able to work it out. I was reading most are saying that this is going to benefit New Zealand's economy much more than Australia's,
right.
Which kind of makes sense. But apparently, a lot of the revenue generated between Australia and New Zealand air travel is Australians flying to New Zealand for snow sports, skiing and snowboarding in the winter months. So it makes sense that they kind of wanted to get this sussed out before the ski season starts, because I'd imagine from a New Zealand point of view, they really would like flights to be happening so that they can rake in the cash from the Aussies going over there to ski. That's why there's such a discussion, such a talk around being able to get to Queenstown, because I think a lot of Australians like to go to Queenstown to ski.
Right. Yeah.
But very, very interesting.
Very good.
But yeah, moving on from that, as a kind of a little bit of a follow-up, Australian government is clearly preferring Australians to holiday in Australia, though, even though we are opening back up to New Zealand, because, and this is a fairly old news story, the federal government will halve the price of nearly 800,000 airline tickets as a part of a $1.2 billion package aimed at getting more Australians to spend big on domestic holidays. Now, as I said, this is fairly old. This was announced back in early March, but the reason I'm bringing it up now is because the first round of government-assisted airfares have now gone on sale.
Wow.
So about 46,000 discounted fares getting offered each week via airline websites from April the 1st to July the 31st. So I think there's like 11, I've got them listed here, 11 places that are included. They're essentially places that really rely on tourism. So destinations are the Gold Coast, Cairns, Whitsundays, Sunshine Coast, the Lassiter region, which includes Uluru, Alice Springs, Launceston, Davenport, Burnie, Broome, Avalon, Merimbula, and Kangaroo Island.
Right.
So return flights to the eligible locations listed above will receive a 50% discount covered by the government. Thank you very much.
Wow. So they're really pushing on people traveling in general, but of course traveling domestically. That's going to be a huge push for demand for convincing people to travel. And I'm sure the airlines are very, very happy about that. That's very interesting.
Absolutely.
Yeah.
Yep. And I think this is kind of tying in with the fact that I think it's JobKeeper is now finishing.
Right.
And the government's kind of stance, which I was reading through this article, the government's stance is kind of like, well, you know, direct business assistance is great and all. Like that's kind of what JobKeeper is. It's just straight up just give them money, you know. But really what needs to happen now is the stimulus needs to encourage an action, encourage a return to some sort of normal activity. So I guess instead of just like, oh, okay, here you go, Qantas or you know, Virgin, here's your JobKeeper payments. Instead, they're going to be like, all right, well, let's encourage an action by instead using that money to help people get back to flying, you know? So
yes. Yeah,
it kind of makes sense.
Yeah, because of course the normal activity, we want to get back to a point where people are wanting to travel and wanting to spend money. So doing little bits of stimulus that kind of encourage that kind of activity rather than just kind of replacing people's income, which has kind of been what's happened, I guess, for the past 12 months. So interesting. We'll kind of see how it works, I guess. No one really knows with how any of these stimulus sort of ideas from governments will pan out, whether they'll work or whether they'll fail miserably. We'll just kind of have to see what happens. But that's certainly making me want to travel, incentivizing me a little bit more.
Absolutely. Yeah, no, exactly right. But I think that's just about all I had for that one. Do we have what else can we talk about today? Yeah, you got some more news, don't you?
Yeah. We should talk about Facebook. A big Facebook event happened this week that a lot of people have probably seen and are probably not too happy about. But I kind of wanted to go into the details of it. So you may have seen a headline this week that 500 million phone numbers and emails were leaked by a Facebook hack. So that's 500
million.
500 million.
That's 500 million people.
Yeah, I mean, we talk a lot about Facebook's great numbers being like, 1 in 4 people use it every single day. Well, 1 in 16 people just lost their phone number to a hack.
Whoa.
So there's the reason why I wanted to start with that headline is because that's the headline you've probably seen everywhere, and it's not exactly an accurate representation of kind of what happened, but
classic media.
Nevertheless, it's very disturbing to hear that many people have had their phone numbers and emails compromised in some way. But it's not really a new news story. So back in 2019 is when all of this happened, but there was an update that happened this week. So in 2019, a group of hackers were able to use a loophole within Facebook to scrape the website for emails and phones, and phone numbers. So they didn't actually hack into any kind of security within Facebook. It's not like they got into the back end of Facebook and were able to find all of this, passwords or phone numbers or anything like that. They used a trick. They used a feature that used to be on Facebook that's not anymore. So you used to be able to search for profiles by entering someone's phone number. So if you knew someone's phone number, you could use the search bar, type the phone number in, and it would connect to their profile. Just as like another way to find them. And you could do the same thing with emails. So you could like type in someone's email if you knew it and find their profile. And that feature seems like it's just so harmless on the surface. I don't know. Does that seem to me, that's just like, I've got this phone number. It's connected to this person's profile. Let's, should be able to search for it.
Yeah, it does seem harmless. Like the only thing I can think of is it would enable some scammers, because you could, if you had their phone number and then it linked you to a person that was called like Jenny Smith. I mean, you could send them a text message being like, message from the Australian Taxation Office for Jenny Smith. Please pay your tax bill or something. So I guess you could scam people with it. But yeah, apart from that, it does seem like. Yeah, it does seem fairly harmless.
That is exactly what happened, Brandon. So
legitimately?
Clearly you're very switched on. No, so Facebook obviously didn't foresee this happening, but this group of hackers were able to use a piece of software that basically used the search bar and entered in every combination of every phone number possible. And what would happen is they would enter a number and it wouldn't be connected to a profile. So it would just track nothing. But then eventually they would hit a phone number and it would therefore tell them that's a real phone number, and it tells them the person and sometimes the email address as well associated with that person, and was able to store them. So they're able to use this piece of software that is called it's called scraping, where it's not really a hack, but they're able to scrape a bunch of data off the website. And they were able to do this in 2019 and get 500 million phone numbers that people had publicly listed on their profile. Facebook was very quick to point out to the news outlets that this wasn't a hack, even though a lot of people were calling it a hack. But I mean, that doesn't really make it any better. It's still
end result's the same, isn't it?
Yeah, exactly. I mean, there is kind of a silver lining that if you had your phone number on private on your account, then you couldn't have possibly had this happen to you. But at the same time, most people have either their email address or their phone number or both publicly listed, and it still in a way is very negligent to allow someone to just pull all of that data from the website. There should be protections that stop people from pulling data in massive numbers off a website in that way.
Yeah, definitely.
So yeah, very interesting kind of thing happening. So 500 million phone numbers in total. There was a few million emails as well. And in Australia specifically, it was 7.3 million phone numbers. So
wow, that's a lot of us.
Just under a third of the Australian population.
That's a lot of us.
had their phone number scraped off this website. So what you mentioned earlier is exactly what these kind of phone numbers and names are used for. You'll probably see those text messages that you get every now and then where it's like, this is the ATO, there's a problem with your account, click this button, or you'll get a phone call and someone will scam you in some way. That's kind of how these phone numbers are used by scammers. And this was all the way back in 2019, but the list was actually posted this week. So someone publicly posted the entire list, which is why everyone's kind of up in arms about it. But the only last thing I had on this story was you can actually use a website to check if your phone number's been scraped from Facebook or your email address.
Right.
There's a website called Have I Been Pwned? So owned with a P, pwned.com. You can just Google search that or go straight to the website and you can just put in your phone number or your email address and it will basically tell you whether you were a part of this hack.
Right. Have I been? I'm doing it now.
And then this website steals your phone number. This website. I obviously I don't know this website. So look, take it with a pinch of salt. But it was listed on a lot of news articles as a way that you can legitimately check whether you have been a part of this scraping.
I haven't.
You haven't?
Well, it thinks I haven't.
Yeah, I haven't either. So
nice.
Which was good.
We're safe.
We're safe. We're part of the.
Apparently.
Yeah.
Jeez. But that's like 1 in 3. That's like you, your partner, or your mum. It's like 1 in 3.
Yeah.
That's insane.
Insane. It is an insane number. When I saw that headline, I was just like kind of just speechless. Like 500 million phone numbers.
That's like a bloody lot of phone numbers.
It's going to take a while to go through them. I guess that's the silver lining though, right? I guess I guess if someone hacks 500 million phone numbers, then it's better than if you were on a specific website and they pulled like 1 million and yours is in there because they're much more likely to go through them. But yeah.
Man, you'd hope you'd have unlimited SMS and unlimited minutes of calls per month to be able to message that many people.
It's just one guy with
it's just this one guy. 0411 111 111 0411 111 112. Hello, Jenny.
Oh dear.
Oh dear. But geez. Wow, 500 million, that's a lot of people. Fix your game, Facebook. Far out. That's a gaping hole in your flipping privacy. I mean, you want to talk about safe, secure, privacy plus. We love Facebook. And then you let people type in your phone number and find out who you are. Jeez, there's something that sounds a bit dodgy with that to me. But anyway, should we move on? What else we got to talk about?
Where should we go?
I can talk about, this is kind of interesting. The Amazon launched AWS Space Accelerator with a UK venture firm to help space startups grow, which, it's not a revolutionary news story, but it's still kind of interesting. So Amazon Web Services has announced the launch of a new space startup assistance program on Tuesday. Well, this is Tuesday last week, with the tech giant partnering with UK-based venture firm Seraphim Capital on the project. The AWS Space Accelerator is a 4-week business support program that will take place in June. AWS Vice President of Partners and Program, Sandy Carter, wrote in a blog post. The accelerator will select 10 companies to participate, with startups receiving as much as $100,000 in AWS Activate credit, essentially funds to use for various parts of Amazon's cloud service. Startups will also receive mentoring during the accelerator from space domain and technical subject matter experts with deep experience working on AWS. Startups provide a catalyst for, this is a quote from from Clint Crozier, apparently. Startups provide a catalyst for bold new experimentation in the space industry. We look forward to helping the first cohort of companies launch and grow through this new program. So
Right.
for most people, this is going to be like, that's kind of like a non-story. Cool. AWS is helping space startups. But I actually really like this because obviously I'm a big fan of, space companies. But typically, like, there's a reason that there's not very many of them. And it's quite simply because it takes a ton of money to start a space company. And in a lot of cases, it's not very profitable. Like, if you want to make money, just go and build a software as a service business or something. So a lot of that's like, even Elon Musk himself, when he started SpaceX, he said he thought that SpaceX had under a 10% chance of success. Because people just, quite simply, they look at space and they go, yeah, space is cool, and astronomy and planets and space travel, yeah, but there's no money in it. Well, not yet anyway. So I kind of like this, that, AWS, and you can imagine why, because Jeff Bezos, he runs Blue Origin and he's really into space as well. But I kind of like it that they're offering this 4-week mentoring support program, $100,000 of credit to help use their software and help some sort of space-related startups that show promise actually get up off the ground. I think this is really cool.
Yeah, it is very interesting. It is kind of one of those industries where it's very difficult to get to generate revenue of any sort, and it's very capital intensive. And it seems to be,
absolutely.
It seems to be at the moment just kind of, it's like a side project of a lot of some billionaires who have built other companies that are very profitable or have achieved some kind of profitability. So it is kind of at that stage where it would be very, very challenging to get into this space. So very interesting. Not an area that I've personally looked into very much, I'll be honest. But I presume they get, at the moment, the way they generate revenue is through getting contracts with the government, right? I would imagine if there's some sort of there's some requirement for space travel with governments.
Yeah, I mean, generally, space companies, they just launch satellites,
right?
And they just provide launch services. That's pretty much how SpaceX makes their money. They just launch stuff up, and people pay them to launch things. Or alternatively, they themselves operate some sort of satellite system which people want to buy that service kind of thing.
Okay.
Which that's kind of like what Starlink's going to be. Like SpaceX sending up all these Starlink satellites for global coverage, internet, and then people just pay for access to that internet connection kind of thing.
Yeah, that makes sense.
But yeah, no, I like it. I like anything that, like, I love it when NASA gets more funding. I like anything that supports the space industry, because a lot of people don't know that a lot of humanity's greatest innovations that we use down here on Earth have come from space exploration. Because space is like the frontier, that's the hardest thing that we're trying to figure out at the moment, is how to get out there amongst the stars.
Yeah.
It requires a lot of engineering and a lot of innovation, and a lot of those innovations that come about to help us in space somehow get brought back down to Earth and help us out a lot on Earth. And there's you can even look it up on Wikipedia. There's this massive long list of technologies that we use every day that have come from space exploration.
Wow.
So
fascinating stuff.
Yeah. Anyway, that's kind of a story that I'm interested in. Maybe not everyone would be interested in that, but I thought I'd chuck it in anyway. How are we going for time? I haven't even. Should we jump into Q&A?
Yeah, I reckon let's get into some Q&A questions, because we've got quite a few building up now. We've got a decent amount of them. If you do have questions that you want to ask on next week's episode, or even news topics or anything like that you see throughout the week, then make sure you head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Or of course, you could just search for that on YouTube and you'll be able to find it. Just click on the latest episode and go down to the comment section and leave your questions down there. And every week we go through and we scrape through the comment section.
We scrape the bottom of the barrel of your questions. Gosh, no, we love your questions.
We've just got to filter through all of the scam comments now. People trying.
Yeah. Hey guys, great podcast. I would just like to know, do you guys invest with Sir Adam? He can be reached at WhatsApp +1.
No,
blah, blah.
stop.
Yeah. It's so true though. How bad are YouTube comments these days?
Oh, it's terrible.
It's really it's the comments section on my videos is almost just unusable now, from the amount of spam. And other people, I'm by no means a large channel. Some of the other guys have it far worse than I do.
Yeah.
It just sucks because the comments are so great. I love talking to people in the comments, real people.
Yeah.
But it's just,
and I really like, even if I don't have time in that particular day to reply to comments, I do like kind of just flicking through them and finding something I like and doing the little heart reaction.
Yeah. Absolutely.
The problem that I've found recently is if I do that and then a scam comment uses my profile and comments underneath, it's very easy for someone to believe that I've basically liked their comment and then left that comment.
And given a reply.
Whereas it's really me that's liked the comment, but it's not me who's given the reply. And that's kind of dissuaded me from wanting to do those, even that. So it really is making it unusable, which is kind of disappointing, but it is what it is.
Yeah.
First world problems.
Yeah. It's bloody annoying though. Let me tell you, it's so annoying from our point of view. But anyway, let's get into some Q&A.
Yeah.
Where should we begin?
Yeah. I might read this one at the end for you. I think this is a good question.
Sure.
This one came in last week. Hey guys, I was just wondering what news sites or subscriptions you use or can recommend for information about markets and specific businesses. Do you check the business and financial news daily? And if so, what are you using? By the way, I really enjoyed the in-person session you guys did. Hopefully more like that in the future. Oh, well, thank you very much. We love doing those podcasts.
It's good. I might come back down to Melbourne fairly soon, so maybe we can schedule up another one. Yeah, within the next month or so.
Wow. Yeah, we should 100% do that. We could even just go back to the same place that we shot it.
That same place. That was such a good place. Yeah, man, that was so good.
They were really friendly. That was a really good setup there. Yeah,
really enjoyed that. That was fantastic. Anyway, to your question, financial news. I really wish I had a great structure to tell you, I do this, then I do that, then I do that, then I do that. But I really don't. I just, for instance, a lot of the keeping up with the news is for this podcast. And to do that, I, look through CNBC quite regularly. All of these websites, you always got to take it with a little bit of a grain of salt. So you do have to do your research. If you find something that catches your eye or that you want to explore further, then you have to research it properly, because of course there's always vested interests, CNBC or Bloomberg or news.com.au. That's obviously owned by Rupert Murdoch. So there's always these little agendas hidden within the content. But generally speaking, I'll just look through CNBC. I might look through Bloomberg. I don't have a Bloomberg subscription, but maybe if I find something I want to read about more, I'll just research it through some other news sites. Business Insider is one that can give you some good stuff occasionally. ABC, the ABC News website, I kind of scrape through for information. But in terms of individual businesses, I mean, typically speaking, I'm just looking at stuff that really comes out of the company. Because, man, if you just believed the news on, the companies that you have in your portfolio, geez, you'd probably make 15 different trades per week. You'd read some articles which are saying, oh, this is a terrible buy and it's going downhill because of this reason. Other people would be like, oh, it's going to the moon because of this reason. Yeah,
I mean, that is the truest thing ever. And I just saw something this morning that kind of made me laugh in relation to that. I saw, because I keep up with the restaurant industry, and for an extremely long period of time throughout 2020, all of the articles were deeply pessimistic about US restaurant companies. And I saw an article from CNBC this morning that was they basically did a segment on their show, and they were talking about how good it is to own restaurant stocks right now, how good they are. And I just went through and I just had a little look, like Starbucks up 100%, Texas Roadhouse up 300%. Like all of the restaurant stocks have already gone up so much.
Yeah.
I think Texas Roadhouse is at like a 45 price to earnings ratio. So like, it's just hilarious. Like some of the stuff you get from some of the opinion you get from news is literally just people looking at stocks that have done well in the past and then being like, this is a good stock to buy now. And the vice versa.
What's been trending in the last month?
Restaurant stocks are down 70%. How far can they go down further? And then the opposite direction. Like they're up 300%, but I think they could keep going. I think they've still got it in them.
Like one Bitcoin's like $100 and they're saying like, oh, Bitcoin, there's no way that's the future. Don't buy it. Bitcoin at like 80 grand. It's like, oh, Bitcoin's the future. You should buy right now.
Bitcoin to 1 million.
Yeah, exactly. Oh dear, so true.
Oh dear. No, but to sort of give my answer to this question as well. I mean, everything that Brandon said is very similar to what I would go through. I'm just trying to think if there's anything else I can add. In terms of industry data, I like to use Statista, which is really good for industry data for Australian companies and US companies. You can use their free. That you can use it for free, and they have quite a lot of data available. I actually recently started using their paid subscription because I think it's really good for certain industries, things like retail and restaurants and that sort of thing. It's very, very good. There's a lot of data to go through, and it gives you access to a lot of sources off Statista as well, just research firms that are doing papers and stuff on certain industries. But beyond that, do I check the news daily? I wouldn't say I check the news daily. I get notifications on my phone from Google News if there's news related to companies in my watch list, but I will almost 99% of the time just flick them off. Like I'm not clicking on every single notification and checking each article unless it's something that's serious or important. Yeah, I'm not really reading the news on a day-by-day basis. Yeah.
All right, let me ask this one to you, Hamish. I enjoy hearing you talk. It would be nice to see you walk. Would you consider signing up for an eToro account, and then we can all follow along with the investments you make there? You don't need much cash to show in principle how you operate and get results, and it might give you another good avenue of content. For example, eToro account updates. How was your month this month, Hamish? Blah, blah, blah. What do you think about this, Hamish?
Has this person seen my eToro video? I'm not too fond of not too fond of the eToro. I think there is a feature in eToro where you can do what's called copy trader, whereby you put your portfolio publicly and you can actually just straight up copy people's portfolios, which I think is absolutely ridiculous considering eToro is only a few years old anyway. So there's nobody. Obviously no one who has a good track records on eToro anyway, but true. They're not long track records anyway. I give my results in every 6 months. I do an update on my portfolio, but anything more frequent than that is kind of it's pointless because it's month by month, and even every 6 months is pretty pointless. Like in most of those videos, regardless of whether it's a good it's been a good, last 12 months or a bad last 12 months. At the end of every video, I say, look, this is a 12-month period. Like you take it with a pinch of salt. Like it's just 1 year. It doesn't tell you anything. So I don't think
really you should make those videos like once a decade.
Yeah. Pretty much like maybe
judge me over 10 years.
Yeah, exactly. You want to see a record over an extended period of time. And I just think I used to do these monthly at the very start when I started doing YouTube, and it was just pointless. Like nothing even happens. I haven't even, sometimes I think the last portfolio video I did, I hadn't even bought any stocks in 6 months. So, I don't really trade that much. And if I was updating it every month, then the other thing that's a worry is people are actually actively copying you month by month. Whereas at least if I do it once a year or every 6 months, it's kind of difficult to copy, at least less so. But
I would definitely not do this. I would definitely not allow people to follow the investments that I make. That's why I just like, you still talk about your portfolio. I don't even do it.
Yeah.
I just don't even talk about it really. You can probably work out my portfolio if you like watch every single video I've made for forever. You probably know what stocks I hold. But I don't talk about it because, yeah, you're right. You'd make a video or you'd be like, yeah, I hold, for example, people know that I hold Tesla. And if I just said, yeah, I hold Tesla, people would just be like, oh, okay, I got to go buy Tesla. And it's like, well, yeah. I bought Tesla in 2017 for Christ's sake. So there's so many just problems with these, showing your portfolio, this is what's in there, and people just copy them, but they don't really understand. They don't do the research. They don't really know why they're buying it. They're just buying it because you're buying it, blah, blah, blah. So I don't think I'd ever do something like this.
Yeah.
Yeah. Should we do one more?
Yeah, let's squeeze one more in.
You want to do this one. Bruiser?
Straight at you, Brandon.
All right.
Hey guys, love the podcast. A couple of Q&As, a couple of questions for Brandon. Tesla had a first mover and visionary advantage in so many areas, vehicle technology, self-driving technology, distribution, battery tech, etc., that has made it successful now. As you mentioned, Tesla is now accepting payments for vehicles in Bitcoin and holding it on their balance sheet. To this point, it seems you and Hamish have been both relatively dismissive of Bitcoin, which for what it is worth, I mostly agree. However, when investing in Tesla, you were willing to accept other of Tesla's and Elon's bold visions for his business that have now paid off very well. As a Tesla shareholder, how are you viewing this move? So this move meaning the Bitcoin, the changes in Bitcoin. Do you personally think it's a game changer? Blah, 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 blah. What do you think? What are your thoughts on it?
Look, you hit the nail on the head. Like, I've been willing to follow Elon in the past and, put faith in his management and the decisions he's made, and it's turned out very, very well. But you are correct that I don't really see Bitcoin as the future of currency or something. Like, I don't know, it could go up, it could go down. I mean, it's just very volatile, and I don't think if I was a public company, I don't think I'd take that risk with the money on the balance sheet, even though you could argue that, fiat currency has that risk of going up or going down, being worth more or being worth less, which is the argument at the moment. I don't really mind the Bitcoin stuff with Tesla, just because, well, firstly, they only sent 1.5 billion into Bitcoin, which is a lot of money, but for a company like Tesla, it's not a lot of money, kind of thing. So even if that 1.5 billion, I mean, they're smart. They know that Bitcoin's volatile. They're not going to put 100% into Bitcoin because they could just get absolutely destroyed and then they would be in real trouble. So they're not going to take massive risks like that. And, I'm okay with them offering Bitcoin for their vehicles. I mean, that's as we spoke about. I think we spoke about this on the podcast. I've made a video about it as well. I don't think very many people are going to take them up on the offer just because they have to realize a capital gain. Because when you dispose of Bitcoin, even if you're buying something with it, you are disposing of the Bitcoin and you have to lock in your gains or losses associated with it, and that has tax implications. So it actually makes buying the car with Bitcoin more expensive. So, I'm not too concerned. I don't think very many people, and Tesla basically admit in their terms and conditions that it's pretty dumb to buy a Tesla with Bitcoin. But I'm not too worried. But, if tomorrow they came out and said, oh, we've decided to change our entire balance sheet to be related to Bitcoin, and now all of our cash, $15-20 billion of Bitcoin is now what we hold, then I'd be like, holy smokes, that's something that I don't feel comfortable with the volatility of Bitcoin. But I mean, they're smart people. They know that Bitcoin's volatile, so they're not going to put their company at risk. That is the last thing they're going to do. Even if they think Bitcoin's the future, they're not going to put their company at that amount of risk. What do you think, Hamish?
Yeah, I don't think I could add anything too much.
Don't have anything to add.
Too much of value here, but
you're the Charlie Munger of this discussion.
Yeah, exactly.
Nothing to add.
No. Warren. Hey, Charlie, have you got anything to say? Just
Charlie-
crickets. There's nothing.
Well, I think Bitcoin's like trading turds.
I hate it.
Full stop.
All right. And with that said, we'll probably leave things there for today. Thanks, everyone, for tuning in, as always. And as I mentioned a little bit earlier, if you do have questions or topics or anything at all that you want us to discuss on next week's episode, head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Click on the latest episode and leave your questions or topics as a post in the comment section below. Thanks, everyone, for tuning in. Thanks, Sharesight, for sponsoring. As always, sharesight.com/young investors if you want to get 4 months off a yearly subscription or try out a free plan for as long as you want. And we'll be back next week. Thanks, Brendan, for joining me, as always.
OG.
And we'll see you guys next week.
All right, we'll see you guys. Bye-bye.
Bye.